afternoon, everyone. Today is the regularly scheduled meeting of the Town of Scarborough Finance Committee's meeting for August. Today is August 16th, 2022, and it is 4 o'clock. Could I have the attendance, please?
Councilor Anderson.
Here.
Councilor Cucci.
Here.
And is Ken not attending?
I believe that Councilor Johnson will not be here today,
Okay. April,
and I am also here.
thank you.
Item 3 is approval of the minutes from the June 21st, 2022 meeting. Do I have a motion?
So moved.
I will second. All those in favor? We'll take it. We'll take John and I and pass the minutes.
All right,
Thank you.
thank you.
Item number 4 is our discussion for today. We have a single agenda item, fiscal health metrics and debt modeling. And we have a guest here with us from Moores and Cabot. Mr. Joe Katura is here. And so we are going to go through some of the materials that he prepared for us. And then we will have a discussion of some of the modeling that Chairman Clucci assisted us with. Which is why he's up here at the dais with us today, in addition to the fact that Ken was unable to join us. And so with that, I will go ahead and turn it over to Tom.
Yeah, that'd be great. Just a couple of introductory comments. So really the exercise that was given to us was really to consider the town's ability to take on 3 major capital projects. And no surprise, I think this is really the discussion is really prompted by the fact that the library project is on the doorstep of going to the voters and potentially becoming a reality. Whereas the other 2 projects are at various stages of conversation. But nonetheless, I think appropriately questions have been raised about our capacity to take all these on in a fairly short period of time. The impact that we've tried to provide analysis around seems to me to be fairly unlikely, just in terms of happening so quickly. A lot of factors have to fall in place. In fact, the only project that's in our CIP for construction funding is the library project at this point. So we've got some internal processes to respect and to follow. And then, of course, we need to go to the voters and secure voter approval. So I guess what I would characterize at the top is that this is probably worst case scenario in terms of bringing on projects as soon as they possibly could. I think it's, again, somewhat unlikely that we'll be able to hit all the marks and make it happen in this time frame. But the model is nimble and flexible and can be certainly modified to create any number of scenarios, but this is the one that we've started with for discussion purposes. In order to really do the debt modeling, there need to be a lot of assumptions. We're looking into the future. So we're forecasting future valuation and tax rates, growth in municipal and school budgets, the terms of financing themselves, how long they are, at what rates. So just appreciate there's a number of inputs, and those are up for discussion. I don't think any of us claim to have a crystal ball in that respect, but I think they're reasoned, educated assumptions that have been made. And I expect we'll get into some of that this afternoon. But really, before we jump into the modeling, I think it's important to kind of lay the groundwork. And Joe has been our financial advisor for over 20 years. 22, is that right?
Yeah, just 20.
20. And so has a long history with the town, has really done a superb job of helping myself and staff and councils as through the years to really understand the whole bond rating process and kind of how we get to the point of selling bonds and how that all works. And Joe, in doing so, also has a very keen sense of helping us understand what our financial abilities are and how we compare to others. And so I think it really behooves the committee to spend a little time getting that background, kind of building up to the debt modeling discussion. So with that preface, Joe's here to kind of walk us through some of those basic metrics and has promised to make fairly quick work of it, I think.
Absolutely. Thank you very much. My wife's a stockbroker, and I was responding to an RFP for the city of Portland about 30 years ago. And I said, bonds in my life, so pardon me if my passion shows. And she said, it's a true statement, get a life. So I like bonds and try to bring that to the party. I've been doing underwriting bond issues for 30 years. I've probably been doing this before your parents were born, certainly in high school. On page 2 of the slides, what I've done is try to measure our expectations, tell you what I'm going to tell you, and then tell you what I told you. And these are my presentation moments. And this, of course, is up to any questions that may be asked. More than happy to address them. But I'll sort of go through what I see as the fiscal health of the town of Scarborough. And I've done this recently for Kittery, for Cape Elizabeth. I do this for City of Bangor every year. And so this is a process that I kind of enjoy. Now, there's a certain amount of material in here, and I'll identify it, that is absolutely not germane to this, but it's information that I think would be of interest. Like, for example, census data, workflow data, that you may not have elsewhere, which is why I will give that probably 15 seconds to talk about it. But on page 1 of the presentation is the an introduction or a profile of Scarborough. If you knock the next slide, if you could. And basically, here's Scarborough, as we all know, but lower in that slide is the real key here. Good news, bad news. What really helps is future potential tax base. And of course, Scarborough has grown by leaps and bounds over the last 20 years, we all know. It's become less rural and more suburban, in my judgment. You still have, as of 2020, about 23% of the land is still undeveloped that could be. And I take out of that exempt facilities and green space that can't be, like across from what's that restaurant, Anton's? I don't think you're gonna see a lot of housing on the left, on the shore side. But having said that, that provides a tremendous amount of explanation for growing. And Scarborough's like a teenager. Your pants are not gonna fit, and then they're gonna be too short, and they're gonna be too long, and then they're gonna fit, and then they're gonna be short and too long. And this is part of growing. With that comes responsibility to provide the infrastructure to be able to handle that. On page 2, next slide, TIF district. Scarborough has, I first was involved in 2002 with trying to figure out how to finance the Higas Parkway. And of course, if we knew in 2002 what we knew in 2012, we would have done it differently. But our first goal was to see how we could provide a financing, and then 10 years later, we restructured it so that it was not a burden on the general fund. At one point in time, about 10 years ago, the Higas Parkway had a total of like $4.5 million of receivables to the general fund. And Moody's discounted that receivable in that they said that the receivable should drop, not increase. And it went from 500 a year for like 6 years. And we're just at a point where we've totally funded that by restructuring and having development, which we missed for about a decade. Retail sales come up a little bit on the slide. You can see that, I'm sorry, come to the bottom of that slide. Thank you. That the sales, despite the pandemic, there was a dip in 2020, certainly, but we seem to have recovered rather nicely. That while we are part of the Portland, South Portland MSA, and while we do have a lot of shopping on opportunities away from Scarborough, there's still a lot of commerce and development. I buy all my, well, when I lived in Portland for 10 years, I bought all my Volvos down the street. Unfortunately, living in New Hampshire now, I don't want to pay sales tax, so I have moved. But this is retail sales data that sort of shows the multiplier effect of the sales. And this is unique to the town of Yarmouth itself from the sales tax. Okay, the next page, building permits. And I don't have 2021, but you can see again that they sort of lagged a bit, except the building permits have a different life. It's almost like a 2-year lag that even with the pandemic in 2019 and 20, there were certain things that were going on in 2000, plan in 17, 18, 19, and 20 that kept on going. So we've still seen a fairly sizable increase each year in the new construction, which is added to tax base. Some of that may or may not be TIFT. but it's interesting. The last part of that slide, the bottom part of that slide, climate change. There are three areas the rating agencies are concentrating on now: climate change, cybersecurity, and GSE, governmental, social, and environmental. And they're just focusing a lot of time. And when we did our financing for Scarborough the last time, the town was kind enough to direct me to some language here, maps that we published in our official statement that shows that Scarborough as a coastal community is aware that it's in fact taking a proactive stance, and that we're not just sort of sitting here hoping that we can build some dikes and get the water out. Now, the reason this is important is two things exist as far as the rating agency is concerned, and this is totally bourgeois. They're concerned that you will lose tax base because it'll be underwater, or they're concerned that you will have to build dikes and levees and tremendous amount of millions of dollars of infrastructure, seawalls, to protect the land base that you have. So that this becomes very important to the investor, and it shows Scarborough's management expertise. Okay, that's my first 5 minutes. Moving on, and this will be a very short one. It might be interesting on page 4 to be aware of, this is an extract from Title 30A 5772 of Maine statute that are basically the rules that allow us to borrow. First rule is municipalities may borrow money for things municipalities may borrow money for. It's pretty straightforward. In Massachusetts, for example, they have fire hydrants for 7 years, an asphalt sidewalk is 5 years, a concrete sidewalk is 8 years. Maine doesn't have that. Basically, you can borrow up to 30 years for any project for which a municipality can borrow money for. What we try to do, though, and this will come probably in our other conversations, is the IRS code gives us some guidance that typically you don't want to have the asset 120% of the value of the asset should be amortized over the period of time you're going to do your bonds. And so, I mean, if you're building a library, I hope you get 50 years out of it. If you're building a community center, I hope you get 50 years out of it. And so these are important things to match the useful life to the project. I provide advice. I show A or B and let you make the choices. Like my children, that I can give them the advice, but they can take it or they cannot. The first payment has to be within 5 years, and the bonds can be callable. And we've taken advantage of this a variety of times with Scarborough, where we've refunded prior debt at higher interest rates and provided significant savings. And in one financing in particular, when we did, was it the high school project that we did 4 years ago?
It was the Wentworth project.
Yeah. That we were able to finance $50 million of school bonds. And by restructuring the debt, most particularly the highest, we were able to provide $50 million project where the mill rate did not increase for 5 years. It stayed absolutely flat. This can be done with good management. And it's not science, it's not gimmicks. I refuse to participate in fraud. I refuse to participate in scandalous behavior. However, I do look at the rules and try to advise opportunities that exist that someone otherwise might not have thought of. At the bottom of the slide, the rating process. Basically, Moody's would say and Standard & Poor's would say there are 4 levels: economy, finances, debt, and management. I add legal security because legal security, if you're Auburn Water District, then you're subject to the PUC for rates and oversight. If you're the Auburn Sewer District, which shares the same facility, they share the same equipment, they do not have PUC oversight. So on a credit point of view, the legal security of the sewer is better. If I had to draw a choice between the two, it's probably a stink better, but it's better. In our case, we have LD1. I have a municipality, a AAA municipality that refuses to go over their LD1, come hell or high water, and it's a credit negative because LD1 is dictating their process. City of Bangor, however, for example, increased their LD1 by $1 one year just because they could. And they've had overrides and underages in prior years. It's a credit positive because they have not LD1. They've been able to work with statute and they've not had it manage them. They are able to manage its process. And I'll talk about these other aspects. The next page, and again, this whole rating thing is supposed to take just 5 minutes. And well, you may be interested in actually what is a AA, AAA. And so I've extracted Moody's and Standard & Poor's definitions. Investment grade is BAA, BBB, or higher. Speculative grade is lower than that, which means that if you buy bonds in that range, you're probably supposed to go to jail anyway, just as a municipal official. But this sort of just gives a good explanation. Moody's adds a plus or a minus, so A minus, A plus. Moody's adds a numerical A1, A3 double, A2, A3. And so the next page sort of clarifies this. Again, I'm zipping through this. There won't be a test after, by the way. This is as much for your reference and for your future reference. I hope you sort of keep this stuff around to answer questions you may have in the future. So when you call me for a better explanation, I'll have it. Now, City of Scarborough, Town of Scarborough, I'm sorry, is rated AA3 by Moody's, and it's rated AA plus by Standard & Poor's. And the AA3 by Moody's is a reflection on the Higas Parkway being a burden to the general fund. But they're both high grade ratings. Capita, for example, is AA1, AAA. I noticed one of the questions here, someone said that it's 2 notches below. Well, it's only 1 notch below by Standard & Poor's. And my job, when I started with Scarborough, I believe they had an A1 rating. My job is to get us to as high a rating as possible. And I can't, I have to confess that there's a certain amount of pressure on Tom every year to make sure that I keep that mission in mind. And that's why these reviews are important. The value, a benefit council member took me to task and said, you know, AA, A, what's it mean to me? You know, tell me in dollars what it means. Well, I've put some tranches here that if you could raise the slide another inch or two, there you go. 10 basis points for $10 million for 20 years is $100,000. So if you went from an A rating to an A plus rating, it improved you by 5 or 10 basis points in terms of a lower cost of borrowing. If you went from an A plus to a AA minus, however, you're moving from an upper medium grade tranche to a high grade tranche. And you would probably pick up 10 to 15 basis points. We saw this recently when Portland went from a AA plus to a AAA by S&P last April. And we're talking probably $600,000 in interest was saved because of the rating. So this quantifies why we worry about the rating. And it helps answer the question, why do we care? And it's just quantitative. Next page is the methodology. I'm not going to go through this at all, but this will help you understand how the rating process goes. Standard & Poor's does not care about fund balance. They care about what you do with it. Moody's cares too much about fund balance and population. Moody's will not give a higher than a AA plus rating to a municipality with less than 10,000 people. They just don't do it. You don't have that problem. Next page, please. And see, I'm keeping my time frame here. This is a chart, and I have extra pieces here for anybody in the audience. These are on the town's website also. As of June 30, it tells you the rating for all local municipalities and districts that have public debt outstanding. If you don't have public debt, you don't have a bond rating. I don't care about Main State Housing, Finance Authority of Maine, Maine Bond Bank. I care about SAD 51 and the town of Freeport. And this sort of tells you where you are in relation, and it's alphabetically. And the bar charts indicate that Standard & Poor's certainly has a higher tolerance for the AA plus, and Moody's has a higher tolerance for AA3, which interestingly is where Scarborough is. Okay, the next slide, and this is going to take the rest of my 5 minutes. Okay, and super. Now what I've done is I've superimposed and these haven't changed since 2008. These are what the rating agencies are looking at. And it's kind of interesting to me to see where you measure up and where are we. And we're not talking about where are we versus Freeport or Falmouth. We're talking about where are we versus Waseca, Wisconsin, Orange County, California, Seattle, Washington. This is a national rating, not just a local rating. And so there might be some, for example, if you have your primarily owner-occupied single-family homes, then I submit that you have the ability to have a lower unassigned fund balance, especially if you have like 98% collections. And then if you have 80% collections, or a lot of your tax base are seasonal homes or one major paper factory, then you should have at least 1 year of tax. This is Ed Gagnon in Winslow years ago said he would have 1 year of the taxes as fund balance in case, and as happened, the Hollingsworth and Whitney facility in Winslow closed. But they had a year or two to deal with it. So let's look at these for a second. Household per capita effective buying power. Now, some of these are from the 2021 Moody's report, and some of these are from the census extracts, and some of these are from your 2021 AFCR, which is your comprehensive financial report. 149% of household income per capita buying power. Very strong. It's not surprising that we have a very affluent community that works well. Market value per capita, extremely strong. And this is what is a big burden for me, that a house in Darien, Connecticut versus Wellesley, Massachusetts versus Portland versus Waterville, Maine. The same house will cost you $200,000 in Waterville, and it'll cost you $2 million in Westchester County. But it's a national. So there we go. Market value per capita. Top 10 taxpayers. If you have greater than 10% of your top 10 taxpayers, if you have greater than 10% of your top 10 taxpayers, it shows that you have some vulnerability, that if it's a large factory and they leave, if it's subterranean powers, electric wires, that's a little bit less movable than in Baileyville, where they could close a paper mill fairly quickly. But you're at a very comfortable 7.40%, very diverse economy as it relates to your tax base. Fund balance. And here's an area that is going to get us from the AA3 to the AA2 is, and I know I'm preaching to the choir, this is probably the 6th time I've said this to Scarborough elected officials. You should have enough money in your fund balance so that all your bills came in the first day of the month and no revenue came until the last day of the month. You could operate during that month on a going basis. Any business should have 30 days of working capital available. And quite frankly, you should probably have 2 months. And rating agencies want to have 26% fund balance. I think it's ridiculous, but I really believe you need 16.6% fund balance, which is basically 2 months of unassigned fund balance. And you can include assigned, because assigned theoretically, the project could be deferred, it could be abandoned, it can be through the legislative body pulled back and used. So the rating agencies are including assigned and unassigned. But I strongly advise us to look at those. And I'll show you later on some historical debt service as a percent of expenditures. And this becomes very important. If you have, like Cumberland and North Yarmouth, they're 4%, because SAD 51 is a school administrative unit away from the towns that has its own debt. So it's not included in the matrix. Auburn is like 14%, but 85% of the debt is due within 5 years. And so they have a very aggressive ability and willingness to pay their debt. So what the analyst does is they look at 8 to 12% as a median. And if it's in that range, fine. You are maintaining your infrastructure. If it's less than 8%, either you should have a lot of pay-as-you-go in your CIP, or you're letting your infrastructure go fallow and you're going to have the Marianas Bridge that they had down in Greenwich, Connecticut. And it's going to cause cleanup and then repair as opposed to just doing it as a preventative basis to maintain your infrastructure. And it's like your house. If you're selling your house and you got a bad roof, you're going to get a better price if you put a new roof on it. It's just that simple. And so, and for a growing community, there's a lot more largesse that if we can show you population growth is every census, it's doubling. Yes, that's too bad if you want to have a small rural community, but the fact is Scarborough is a 22,000 people town now. Overall debt per capita, 4,700. Well, it should be about $3,000 range, moderate. But I'm not concerned with that because I'm seeing 149% of the per capita effective buying power. $4,000 per person in Scarborough is a lot different than $4,000 for a person in Machiasport. And Cape, it's different than Cornville, Maine, up by Skowhegan. And so this is what you call the price of poker for the growth, as long as your tax base increases. And here's it's like the teenager with the pants that don't fit, too short, too long, is that you're going to have increase in value, but your population per capita may not have caught up to that yet. But then as your value continues to increase, and let's look at this statistic, 2.09%. Now that's fully diluted. And I'll show you what your real before, but this includes county. This includes regional waste, Echo Maine, if any. It includes your obligation for Portland Water District's water debt, which you're contingently liable for a percentage of your valuation to the total 11 communities that belong to this, that comply with 386104 of statute. So on a fully diluted basis, 2.09 just totally forgives that $4,700. It just hasn't caught up yet. And the fact is, you're not paying all your bonds in 1 year. You're paying over 20, maybe 30, depends upon your desire. And so as these things level out, they will equalize. All right, that's it for the ratings. The last page. This is okay, Moody's. I have basically extracted from rating reports their words. Your strength, you have a growing tax base, above average residential wealth and income, low pension and OPEB. I believe that the main PERS is something like 98% to 102% funded right now. Incredible. I mean, Chicago issues pension bonds every year, and next year is still only 40% funded. So you're very fortunate that OPEB is such a non-event. Other post-retirement liabilities. Nat Tupper and Yarmouth says OPEB, which is basically the implied subsidy that you allow retirees to also continue their medical at your rates. It's an implicit subsidy because the active members are actually paying a little bit higher than they should, and the retirees are paying lower than they otherwise would if they have COLA and then they move on. But it's a benefit that if you stopped it tomorrow, there's no cash outlay. As opposed to a pension, you start it tomorrow, you have to fund it until the last person retires. Okay. Upgrade, large increase in liquidity and reserves. Talk about fund balance. Continued growth in the tax base. We're seeing that with building permits. And we're seeing that every time I read the paper, there's another 265 housing units that they're talking about, perhaps. Elimination of the Haggis Parkway, which is Moody's has just a craw, and they want to see that continue for 3 years where it's totally funded. Downgrade, operating deficits or declining reserves. If you go below 8%, you're really in trouble. Increase in the Haggis again, and deterioration in demographics. If you find that your wealth levels don't maintain themselves at the levels they are, which is something you probably have nothing to do with, other than be a very attractive place for people who want to come to live. Standard & Poor's, AA+, strong economy, management, budgetary performance, flexibility, fund balance of 11% that year of operating expenditures, Good liquidity. You have, obviously, we've done 22 financings since 2003 for the town of Scarborough. And it shows that you have market access, tremendous market access. If you increase and maintain reserves comparable of higher rated peers, to be upgraded. And this is the 16% I keep harping on. Downgrade if you reduce your reserves or reduce your flexibility. So in a nutshell, here are your marching orders. This is part of the fiscal review as it relates to the rating, and I'm done there. And I probably took more than 5 minutes. I apologize. Let's look at Scarborough itself. I talked about debt service component of operating expenses. This is the amount that we're talking here of on the prior chart, that you're about 12% of your current year's debt service as a percentage of operating expenses. That's a sweet spot, and that's where you're supposed to be. And what's also interesting is your debt is declining at an increasing rate every year. A lot of debt's being paid off, and you're going from 8 million to 6 million to 5 million within the next 5 years or 6 years. You had good buying power. You're going to have even better buying power. And again, I'm not advocating. I'm merely trying to look at this objectively as an analyst and just give you information. And I'm not trying to dictate policy. Debt. And look at this. I showed you the 2.09% on a fully diluted basis, but your debt as a percent of equalized state valuation of 1.86%, you're supposed to be at 3% there. And so if we look at it for 4,186 per capita, and that reflects that $10 million of your debt was paid down since that last statistic to 2021's CAFR. That's starting, you see it sort of kind of equalize a little bit here. And the county's got their civic center, they've got their courthouse, they've got their jail. Maybe we won't see a lot more county debt. Maybe that'll start being relieved, which will help us also. But 1.86% for AA3 rated community is incredibly low as a percentage of equalized state valuation. Again, 3% is the measure. What do you say? Yeah, below 3%. Good. And then here's your fully diluted. I've included Scarborough, Cumberland County. You have a contingent obligation to the Portland Water District's water debt, which means that if they default, they can come to you and ask you to charge your taxpayers. It's about a 14-month lag, because first they have to default and they have to come to you. They have to give you a year to do it. Your assessor has to assess it. So from a credit point of view, it really has, it doesn't have a lot of teeth, but it is out there. And the landfill, the $1,442,000, if you look in your audit, you'll see that it's being funded. So that's not it. So it's contingent, it's out there, but it's like I co-signed my son's car loan. I'm responsible for it. I don't expect to pay it, or I expect to take the car back. But these are of potential interest to you. And the last page is reference to the state. This is grant. If you had 15%, 20% of your general fund revenues from the state, either through revenue sharing or school subsidy, wow, I'd hate to have seen you during the prior administration, which I'm apolitical, but there were very tight purse strings. The state has been very fortunate in the last couple of years of having generated a lot of revenue, and that's been passed on, and I guess we'll continue. Great, but the fact that you're less than 10% of your total general fund in terms of revenues from the state, they could, well, furthermore, 2 million of that is reimbursements. Homestead, general assistance, and Betty are not really contributions by the state. And the other is basically your DO, Department of Transportation, matching funds for taking care of Route 1, I guess. So your revenue sharing school subsidy, what's that, $6 million? You're in a very enviable position that it's great having the money, but to the extent that the money is cut off, there's an expectation that you'll be able to handle that distress. Okay, I did give myself, I think, 10 minutes for this part. Okay, good. So I'll steal 2 minutes behind Moody's and put this. Okay, fund balance. Look at that trend. We don't like that trend. Now, there are two ways of looking at fund balance. According to your policy, you include committed, assigned, and unassigned. And so according to your policy, the top fund balances look healthy. Not strong, but good. The rating agencies look at assigned and unassigned against your revenues. And again, your policy is committed, assigned, and unassigned over current year's revenues. The rating agencies look the other way, which of course lowers the multiple. But this is a trend that we want to reverse before you come to the bond market. And I don't know what your 2022 is going to look like, but please, in your 2023 budget process, try to pay attention if it's not too late. This is the only fly in the ointment that I can see that Scarborough has the ability to do something about, that it's painful. And fund balance is not surplus. Surplus is extra money. Fund balance is the money you need in your operating account to run your business, the town of Scarborough Incorporated. And if you want to do that, it's going to be rewarded with rating increase and therefore low interest. If you don't do that, fine, I'll still represent you. But I'm supposed to give you the facts. Okay, moving along. And then here, just the unassigned. See, again, we're able to give credit to the assigned fund balance because we can shift it. And then we look at budgeted expenses, and this becomes perilously low. And thank God you have a lot of assigned in there. So that's okay. So everybody say, look at page 12, get back to me. Policy review. I worked with Larissa and Tom in great detail in terms of developing your debt management policy, which is the most comprehensive policy of any community in the state. It's incredible. It's a policy, and I've got an extract of it. I'll show you. But it does a lot of things, and so maybe this is preaching to the choir. But you get your debt management policy, and then you have a reserve policy on top of that, and then you have an investment policy on top of your reserve and debt management policy. For example, instead of buying treasuries or CDs, you could buy AAA taxable municipal bonds and pick up 50 basis points in yield and still have a AAA security in your portfolio. And I did this with Portland, and we increased their revenue by $10 million a year. But of course, they had a lot of money to invest. And these things can be done by not buying derivatives, not taking speculative risk, not being fancy, just seeing what's out there. For example, Cedars are an interesting investment that they're basically FDIC insured CDs that you buy it, and it has tranches. So you only have $200,000 per institution. So you could have $10 million and have it all FDIC insured. And then any other policies you wish to have. So these are items for consideration only. Next slide, if you would. Here's the thing about policy. You can have a policy, but you have to follow the policy or get rid of it, because not following a policy is as bad as not having one. And you are the board of directors of the town of Scarborough Incorporated, and you are subject to liability if you don't run your town correctly. You have a policy that says you're supposed to do something, and something goes wrong and you follow the policy, you are totally exonerated. If you're supposed to do something and it didn't follow the policy, then you're subject to criticism. And so just to protect yourself, do your policies, something you can live with, but follow them. And here's the part that's going to be an upgrade for you. You have to measure and quantify that you follow them. It's one thing that I provide the investment portfolio to the finance committee every quarter. It's another thing if I can give a paper trail and show the rating agencies that every quarter I give it to them. So develop it, follow it, prove it. If you don't prove it, it's almost as weak as not following. And it's just a discipline. It's a pain in the neck, but that's why you can always assign it to someone lower than you. Certainly not me. Okay. And there's a balance between debt and reserves, and it has to be a good balance. Here's the deal. I am not just a bond crazy money. But if I have a project that costs $20 million and we paid for it out of the last 5-year capital reserves, and I move from Scarborough next year, someone who moves in next year has the benefit of a $20 million project that I paid for that they didn't. And so there's also a benefits received. If I have a project that costs $20 million and its useful life is at least 20 years, let's say 30, and you borrow for 20, you're able to enjoy the use of that facility in our present value basis because you're borrowing on a tax-on basis. You are beating inflation and enjoying the use of that project through its life until the bonds mature. And so there's a reason. It's like the phrase, it's not the interest, it's the principle thing I hate. Or not the principle, it's the interest I hate, but yeah, there's a cost, but the offset of the cost is your tax rate has a track record of increasing. Because your valuations are increasing, because you're developing greater tax base. And so what you're doing is you're spreading that burden. So the person moves in 8 years from now is now paying the last 12 years of that facility that they have the use of. So they're sharing the ownership. So that's the rationale for bonds. I know it years ago it was usurious to charge interest and do all these things. I don't know. But the fact is there's a reason for bonds and there's a reason not to bond. For example, what you might do is look at, photocopy machines and things that might be bonded and decide that if it's less than, and I believe your management policy is very clear on this, that it has an asset value of such and such or less, or 2 years or less, than it should be paid for by capital reserves, not by bond financing. Good for you. And so you sort of anticipated me a little bit on this, but I had the graph, so I had to put it in. But these are things for you to worry about. First thing, you don't have to worry about CSO and wastewater treatment because you have the Scarborough Sewer District as a separate entity, but your taxpayers are your ratepayers there. This is sort of just something to sort of think about. Okay, I am done with my 10 minutes of fiscal profile. Sorry. Okay, pages 14, 15, 16. I'm not even going to go through it. Your reference. Pages 14, 15, I'm sorry. Here is your debt management policy. Again, kudos to you for having it. Kudos for you for following it. Your mission is to now document it. And you have flexibility to issue level principal interest, level principal, depending upon your debt management. You have your fund balance policies. And these policies should be revisited every 3 or 4 years and certainly tightened up to the times. Okay, now here's the 5 seconds a page part. Here's the census data, page 16, 17, 18 of census data. The only reason I put this in here is because you may not have it. It might be helpful to you or your constituents, your residents, to have this information. Knowledge is power. Lack of knowledge leads to foolish debate. And so I think that these demographic items may be of interest to you as it relates to Cumberland County and the state. Page 19 and 20 are kind of fun. I've taken the 2000 census, and the people who live in Scarborough, people who live in Portland, work in Scarborough, 11.6% of your workforce. People who live in Biddeford work in Scarborough, 4.25% of workforce. People that live in Scarborough, but they work in Portland, 31%. And so it's sort of where the people who are coming into Scarborough to work every day live, and where the people that live in Scarborough are shooting out every day to go to work. So I just thought that'd be fun to have. Okay, next page. Bottom of this one. Keep going. Okay. The gorilla in the living room. And this is where I stop. The page 22 has been revised in a very positive manner. And your website also has the debt service schedules that we don't have copies of tonight. I have copies here if you care. But I am told that the town may consider a library project in the next ballot. I'm told that the town may consider a community center. and school, both to be voted on next year, perhaps. If that happens, then I am told that the community center may have some contribution from TIF revenue that will reduce the mill rate impact, and I'll let the town officials speak to that. And as we found on Wentworth School, what happens is that the IRS, and this is my last feeble attempt to show my great knowledge, the IRS has what they call arbitrage and rebate. If you're going to borrow money, they want you to use it. So what'll happen is if you borrow money, you have 24 months to spend it if you issue more than $10 million of debt in a calendar year, which you do. So we can't borrow $135 million today, or we could, but we would have to track its investment, its earnings, add it to it, do a calculation every year, which costs about $4,000 to $10,000, and report to the IRS that you had or had no arbitrage. And if you had arbitrage, arbitrage is IBM stock is in the New York Stock Exchange and on the London Stock Exchange, and it's trading a point away from each other. So you buy on one exchange lower, you sell on the exchange of a point higher, and you have made a profit which you're not entitled to because you're taking advantage of the inefficiencies of separate markets. And so if you borrow on a tax-exempt basis at 4%, and you reinvest it at 5%. The IRS is like, and this started back in 1984 in the state of Alabama, and this is what led Reagan to have the Tax Reform Act of 1986, borrowed $100 million. They bought treasuries. They used the arbitrage profit. They borrowed 4%, invested at 6%. They used 200 basis points to build roads and didn't spend the other money. They just put it into a reserve fund and kept the arbitrage. Well, you can do it once with the IRS, but you can't do it twice. And so they created this ruling. So what we've done, and Tom has, having been exposed to this for Wentworth, and this is why we did that in two finances. I just did $110 million Edward High School, as much as we could use in 24 months, and then 18 months later, as much as we can use for the balance. So we've opted to break this into 3 tranches, to comply with the IRS rules in case somebody wonders why. The good news is you're going to have the bottom of the market, the top of the market, and the middle of the market. And so on the 3, you're basically dollar cost average. But it's not the interest rate. It's you borrow the money when you need it. And then we've talked about an annual CIP of about $6 million a year. This may or may not be accurate. To the extent that it needs to be modified by the town officials, I now turn the podium to you guys, unless there are any questions you might have.
Excellent. Thank you so much, Joe, for walking us through all of that. I know that it took some time, but I am humble enough to admit, as a new counselor and as finance chair, in a position that I didn't think I was going to be in. This is important background information. I think it's important, and I think it's time well spent. So thank you very much for going.
Pleasure.
Yeah. So looking at page 9, and again, under the assumption that there may be 183 million debt in the future.
Yep.
Which of the metrics, I'm guessing on the right, do you see as most vulnerable? And vulnerable in terms of shifting up or are shifting downward?
Debt per capita and debt as percent of market value. But recognize that as part of that matrix, your debt is sorry. Okay, prior. Your debt in fiscal 23 is fiscal year 22 is 10,000,005. Next year it's 8,000,009, then 8,000,005, 7,000,007, 7,000,003. So every year it's reducing by $500,000. So that it's entirely possible, depending on how it's structured, you do the library. And then you add in the community center minus any TIF revenue, if any. And that would keep the $9 million at 9 million instead of 7,000,009. So it's entirely possible this matrix will not change. Your population grows, your AV growth, which would then lead to equalized state valuation growth. So you can't say those are vulnerable, to answer your question, but they're manageable. And this is why, for example, we structured the school to be deferred for 5 years, not the library. And actually, the library has a very rapid amortization of 10. The community center for 20 or 30, no, 20 years. And then we have the school be giving the principal for 5 years to allow the debt to be paid down on existing debt, to absorb the new debt of the library and the community center, and to have the assessed valuation and population matrices catch up. Because in 5 years, I got to believe that your valuations will be higher than it is today. So our desire is to keep that 2.09%, 2.09. Our other desire is to get that 4,700 down to 4,000. And that could happen. I can't promise it, but it could.
Are those two metrics, are any of those metrics on the right, are any of them from a debt perspective, or as the rating agencies are looking at these, are any of them weighted more heavily? Like, are those two more important in their eyes than the other ones, or
Fund balance.
fund balance is the most important one?
Yeah, I'd draw a big red circle around that.
The big black.
Put a slash between the 10.39 and put 16.8.
And that's one that we're poised to actually make some very big gains with little pain, if you will. This year, as you might recall, as part of the budget in FY23, we'll finalize the final CEA payment to New England Expedition. And so all the future resources, you were also forward thinking enough to extend the TIF term another 5 years. So that additional money will go to pay the $3 million deficit that has been such a drag and a conversation point with Moody's and a downgrade as part of our. So all of those things are going to have a very positive, fairly immediate impact on fund balance. Fund balance is really hard to build in a short time period without some pain.
And it's hard to understand. It's like buying life insurance. You know, once you die, you're glad you have it, but until you die, you wonder why you have it. It's tough. Could I respond to some of these questions before I turn the thing over to you totally?
It's up to the chair. If you wishes.
I'll give very quick responses.
Sure.
Okay.
If you feel like that's a good flow for you, Joe, then why don't we do that?
Yeah, I
and
think
then we'll
that'll
take some more
summarize
council
this
questions.
and allow us to just talk about the other projects.
Sure, if you feel like you could speak to something.
The rationale between the different maturity structures, I think I explained that, the 10-year, the 20-year, the 30-year deferring, having tranches. If there's any greater explanation, I can write that down more clearly, or you can look at the debt service schedules to sort of see the gross impact that's on the town's website. Level principal versus level debt service. Well, it's interesting because you do level principal payments has been traditional for municipalities. Interesting, the bond bank does level P&I for most of their projects. I know that my mortgage is level P&I, as is my car payment. Unfortunately, I have both. The Volkswagen's paid for, but the Volvo's financed. And so having level annual P&I versus level debt service, and what I would do if asked is I would do a comparison of the two, level P&I and level principal. And you will see there is less than a 0.5% present value difference between the two, because $1 today is worth 80 cents down the road. So if I am paying $1 million here and 800,000 here, and $1 million here and $1.2 million here, that $1.2 million is worth $1 million. And as a result, on a present value basis, it's indifferent. But today's taxpayers are worried about today's mill rate, and I don't care what's going to happen in 15 years to the mill rate. So as long as it can be shown over the life that there's no economic distance between the two, then there should be an indifference level. Okay.
And moreover, on that point, really the historical strategy of managing debt service costs has really been looking at that debt service as a percentage of expenditures. And it's proven time and time again, if we can keep that in the 12% range, and I think we've been remarkably consistent over time, it really removes those peaks and valleys. It provides for a stable tax rate. Debt service costs is probably the single biggest thing that can provide that yo-yo and bring your tax rate up and down. We've been trying to really keep that as level as we can, knowing that we have ongoing capital needs, and when we have opportunities.
And being level now, the assumption is that your mill rate, that your equalized valuation and your debt per capita would stay static? It doesn't. Your value is going to increase. And so again, $9 million in 5 years is different than $9 million today. And so that there's equity there, there's economic efficiency there. Let's see, okay. Pass on that one. Operating, that's yours. Okay, tax rate, I'll pass on that one. In my fee, I get paid a minimum of $2 per thousand par value bonds issued. As a sliding scale. So once you get to 20 million, it's like close to $1.50 per thousand. Once you get to 50 million, it's $1 per thousand. So you get a volume discount. I probably spend 6 hours in this, at least, for which I don't get paid for. I get paid if and when a bond issue is done. And section 13 of my contract, I think it's on the 8th page, says, if there's no financing, then there's no financial obligation of the community to pay me. So I get paid if and when bonds are issued. And that's sufficient enough for me to want to come here and give the information here. I worked on Auburn Edward High School for 4 years before it was done. I worked with RSU 21 for 3 years before it was financed. That's what I do. And it all works out nicely that I am pleased to say that I think I add some value. I think that the value, if I were to measure the value versus the cost, is probably fair. And that answers the question to the person who wanted. And what we do for my fee is we build it into the interest rate. So it and the ratings are both part of the interest rate. So they're in fact financed. So your borrowing is a true all-in borrowing of all of the costs of the project plus the cost of issuance. So it's and therefore my fee is amortized by you over 20 years. And I yield to the floor.
Thank you, Joe. Other questions for Joe from counselors? Go for it, Don.
Just one, Joe. You mentioned documenting how we're following our policies. Is there something you can share some examples of maybe something that other communities are doing?
Nobody's doing this.
Who might be the first?
I'm the evangelist here saying, please.
Well, I heard you. It's a good point.
You know, if you show the minutes of the meeting where you reviewed it, if you can show evidence that it's been discussed and brought up, this is part of what Standard & Poor's calls their Standard & Poor's has a acronym for it, their management assessment, and in that FMA, financial management assessment. I guess that if you have a debt management policy, once a year, you indicate what it is, where you are, where your expectations are. If it violates a policy, what are your short and long-term goals of getting it back into policy? If it's below your policy, good for you. And then putting that in the record.
Yeah, Project Finance Committee spent literally 3 or 4 years working through and ultimately coming up with this fiscal policy that Joe was kind enough to say is the most comprehensive he's aware of in the state. I think we should be aware, we've really imposed some very high standards on ourselves and should heed his warning that if you have a policy and you don't follow it, that's almost worse than having a policy at all. So there are some reporting requirements that fall to staff, to this committee and to the council. We also in the past have prepared a bit of a dashboard that really mirrored some of the important metrics that came out of that policy. Larissa was the key architect of that, and admittedly we've kind of fallen down and need to kind of redouble our efforts back around that. So
you know, in your CAFR, where you have the supplemental information of how many employees and all that stuff, you may have a 1-page policy, what the policy was, what the policy's goals are, and what your performance was, and at what meeting was it presented. Just that thing, we give that 1 page to rating agencies, and you are the first community to do it well.
Other questions, John? Okay. So at this point, I think without further ado, we'll move over to page 21, which is the modeling that was prepared for us. Which I know everyone is eager to dive into.
I don't know if I can describe accurately the volume of information that sits behind this. This is certainly a summary or a cover sheet. There's pages and pages of multiple spreadsheets that ultimately roll up and produce this one summary. We did provide at least a view-only a copy of that. It's actually, there's a hyperlink on the agenda for debt modeling, so people can actually get under the hood, so to speak, and see how that works. Again, it's view only, but you can see the the level of detail that goes in behind this cover sheet.
Yeah, I'll just comment that the hyperlinked version will open in Sheets. You need to download it to Excel for it to actually function.
Okay.
So I guess I can kick it. So I was originally hoping to stay out of the fray on this one. But given the interest, I didn't feel right sticking Joe covering these slides because they're product of my work in collaboration. There's a lot of assumptions that we bounced off each other, and he certainly reviewed it. But it's something I've got a little experience doing. You may recall last year, Finance Committee reviewed some pretty simple debt management work that I had done where it showed, if we keep this 13% debt service as a percent of our budget, what can we afford, right? When do we have capacity opening up? And if we slot the projects like this or that, it allowed it to be interactive. And where we've come to at this point is a little bit more complex than that, right? Because we want to understand, well, if we do slot these projects this way, what's the impact on our tax rate going to be? What's the impact on a taxpayer going to be? And how are some of these ratios that Joe went over going to change over time? So I agreed to update it. It was done fairly quickly. This is, I think, in the past couple of weeks.
But in every instance, we reconciled, you did your numbers independently of me, and then we compared them, and so we reconcile.
Exactly, for the debt service piece. So one piece of this model is understanding, well, if I bond a school, if I defer interest for defer principal for 5 years, bond the rest over 25, my model implies a debt service schedule for that. Same thing with how we do the library, how we could do the library or community center. We compared notes. So Joe pulled his own amortization schedules together. I compared them to what was in the model, and they're pretty consistent. That also got us to starting to play with things, right? So when you have a model, you understand the impact, you can try to mitigate the impact over time. And that's where, what we're showing here is it looks like it may make sense to accelerate the library because we have some significant capacity opening up in the next couple of years. Why pay that debt service or interest particularly for longer than we need to? And if we stagger in the community center and library after that, it helps to smooth. We're trying to stay as close to that 13% as possible. When we go above the 13%, I have a penalty. So the assumption is that you're not going to be able to do that without impacting the mill rate. You're going to have to take some of that from the taxpayer. To the extent that you're below the 13%, it goes back to the taxpayer. So that's kind of the crux of the model, is we're trying to manage to that 13%. And part of the reason I wanted to stay behind the fray on this is I don't want to sound like I'm advocating that we do this. And I don't think it's at all possible that we're going to take on all these 3 projects in the next 2 years, 3 years. I don't think we have the bandwidth to do it. But the question was, what if we did? And I think I was a little surprised the impact was not as big as, we manage our portfolio of debt. And to the extent, and we have a lot of different options when we do that, like term. Interest rate, we're assuming 4%, but I don't know in the past 20 years that we've ever actually issued debt at 4%.
One time.
Okay. So, we're in a somewhat dynamic market right now that maybe it'll go up to that, maybe it won't. Maybe things will settle down before we actually start to issuing these things.
I misspoke 2 times in the last 20 years.
Okay.
2 times in the last 20 years, we've had an interest rate 4%.
Yeah, the average over the last 22 years was 2.7503%. So I would submit that 4% is a reasonable assumption for this exercise.
And then away from this, I did the bond buyer index 20-year AA bonds with a 20-year maturity. Over the last 20 years was 3.96%. So that's the 20-year bonds of 3.96, which means that the borrowing rate would be 3.75. Okay. So the 4% we feel is an extremely reasonable, historically accurate, quantitatively proven rate.
Probably okay for planning purposes. I'm not sure how deep you guys want to get into it. So the process, I started with the spreadsheet, and then really just tried to create a model that represented the real world. And there's a number of assumptions that go into that model. For doing an impact analysis, those assumptions aren't extremely important because you're trying to see what's the delta. So the underlying assumptions are the same for one version versus another. We're trying to quantify what's the difference if we do a school versus not doing a school now, and how's it going to affect some of these metrics. So we could probably spend a whole meeting talking about the assumptions and seeing how that might change things. I'm open to doing that in the future, or you can download the spreadsheet and play with it yourself and understand how sensitive some of these items are. Fact is, we used what's happened in the past to help guide the future. We know it's not going to be right in all cases. The hope is that they'll balance things out in different directions, or there'll be opportunities to manage if some metrics start to come in up higher or lower than what we expect. So these numbers on the page are really, really small. I don't know if we can zoom in a little bit. I'll cover a couple of the metrics that I brought forward to the summary. Maybe one more. There we go. And then if you scroll to the left, I'll start with this is the key metric that's driving the model is our debt service as a percentage of the prior year operating budget. Go to the left and then up. You know what I think I can probably do is share my screen.
Peter, John's going to share his screen.
So Peter, I think you'll have to stop sharing. Sorry.
Would you write down how he's doing this so I know how to do it next time?
Well, it's funny. I can see. There we go. Share screen.
That's why you attend in person rather than accept the remote.
Oh,
Okay. So now I need to.
I don't know how this happened. I'm sorry. Oh, wait, can I ask Joe a question? There we go. Are you here? You're in.
I think I'm good now. I think April fixed it.
Can I ask you a quick question while we're waiting?
Yeah, Dawn.
Joe, could you describe what, you know that you're self-ops and you focus a little bit about how you get from there.
I can reiterate the question, Dawn. It's up to you. Okay.
Very quick. And welcome back. I've been through several meetings with you, so welcome back. It's good to see you, and we appreciate all the work you've done for us over the years, and it's nice to have a trusted advisor. Can you speak to, you spoke a lot to our role as fiduciaries. We've had a devil of a time trying to convince people who are various proponents for various scenarios of these capital plans to say, well, we are definitely going to go to the voters, but we have a fiduciary responsibility to fulfill first. And that's kind of part of what we're trying to do here. Can you speak to, do you have a fiduciary responsibility to us?
Interestingly, the SEC, or pardon me, the MSRB requires, as a municipal advisor, that I have a fiduciary responsibility to my client as to trust and knowledge. That if I don't have the knowledge, then I must seek someone who does. And I must admit that I don't have that knowledge. I do for this. And that I am working as a fiduciary, not an agent, for the town, period. And I could show you the discussion of that under the MSRB rules of definition of municipal advisor.
Okay, great. Thanks. And I'll just stop there. I had one more question that I'd like to get in before the very end, but I'll stop there. Thank
You got it, Dawn. I'll come back to you.
Okay, I'm going to show my Zoom capabilities now. I have my screen sharing going. This top box, so we modeled a bunch of different scenarios, right? We have a capital improvement plan today. It includes the library, community center, a number of other smaller pieces of equipment or projects. This is what our debt service to budget ratio looks like under that scenario. This one just adds a school. And you can see we get above 15%, 2029. We hover there for a couple of years. So that's a bit of a concern. Then we say, well, what if we take out the library? same thing. We still get above 15%. It doesn't solve that issue. What if we get rid of the community center and the library? And the numbers come back down more reasonable. We still get a little higher than we want in 2034. And then the final column was just added later. Under these assumptions, what's the impact of the library? So on your debt service ratio in 2029, it's about 1.2% for that ratio. Off to the right, we actually just put what the model debt service payments are. So under our current capital improvement program, and I think something probably got in here. Yeah. So this actually includes the SIP, our current capital improvement plan, the community center and the library. In 2029, we'll be paying about 16 million a year in debt service. If we had a school, it'd be closer to 21. And if we take away the library, it'd be about 19. Take away the community center and the library, it'd be about 17. About 1.6 for the library. Again, this assumes that we're doing the library over 10 years. So it's fairly quick amortization, so it's more impact sooner.
Can I ask you a quick question?
Yeah.
If you compare the columns that you just had highlighted to the amortization schedules that are now at the back of the packet,
Mhm.
do those two columns reconcile? Because I know you had said you had made different assumptions about what the payment schedule was.
So what Joe's latest was that's included in the packet now, they're under consistent assumptions.
Okay,
I think the biggest difference is the ongoing SIP. I model it out. I assume we're going to do it 6 million a year every year, and it's going to grow 4% every year. And I do that throughout the next 30 years.
okay,
I think Joe's cut it off in
10 years.
10 years.
okay.
So that's probably the biggest difference. And then, he actually added in the existing debt that we already have as well.
Yeah.
So our numbers are the same for that.
Okay.
Down here, I show what the impact is going to be on a $400,000 home. It's a good guide for me to use when I'm trying to reconcile things. Understand that a $400,000 home today is not the same thing as a $400,000 home 5 years ago or 5 years from now. But the fact is, you would expect your tax bill on a $400,000 home, all else being equal, to stay pretty flat, because typically inflation affects the value of your home as much as it does the cost of operating a town. So those two things usually offset over long term or over the average. We're in a blip right now where home values have gone up substantially in the past couple of years, and inflation hasn't quite caught up to that yet, although we're seeing some of those pressure points now. So another way to look at this, 2019, a $400,000 tax bill on a $400,000 home was just under $6,600. If we do all of our current capital improvement plan and a school, we don't exceed that amount at any point in the foreseeable future. So that's pretty good news, I think, for most people. If you look at the mill rate in 2019, it was 16.49. Again, with the school, we don't exceed that at any point in the future. And these last two sections simply just take the difference. So what's the impact on the mill rate? It just tries to quantify that over time, because that's a question that people usually ask. And this is just a percent, and then over here is the impact on a tax bill. So with the 10-year amortization, library, at its peak will be under $100 in a $400,000 tax bill. So, but under $100 on what is almost a $6,000 tax bill. Some of the assumptions going into this, I can talk through these. I'm going to try to zoom. And then if you're decent with spreadsheets, all of these, the different tabs on here actually show you the calculations that are happening. Bigger.
And the sheet's also on your website.
Exactly. But one of the assumptions, and you can play with the sensitivity, a lot of them, the assumptions are applied equally to each scenario. We assume that the next revaluation in 2025, which is not definite, but that's what's currently planned, will be 25%. That means our overall valuation is going to bump 25%. Joe talked, you talked about some of the metrics just because of market forces. The price of a home today has gone up a lot relative to a couple of years ago. I had originally pegged this at 30% and I ran it by the assessor and he talked me down to 25. So this is his best estimate. Obviously, there's a whole process they're going to have to go through, but he made me aware of some options that the assessor has, right? We might not go to 100% when we do the next reval. We might actually leave some margin there to try to mitigate some of the impact because it's going to be a pretty impactful reval to a lot of taxpayers. There will be some shifts going on. After that, our run rate, we expect about 10.5%. That's what the model's assuming. Every 5 years, we'll do a reval and our values will go up about 10.5%. Our operating budget, this assumes it's going to go up 4.5% a year. 3-year average is a little over 4.5%. It's honestly, it's bounced around over history, but our run rate or what seems to be manageable with this model is 4.5%. We have non-operating expenses. That includes things like CEA payments. It includes overlay that the assessor has for uncollectible taxes. I have this escalating faster than our regular operating expenses. It's going up at 5.4% a year. A large part of that is due to the downs. So, those CEA payments are going to be growing somewhat rapidly. There's other CEA payments that are coming off the books though, that are mitigating that. This is one area where the model could probably be more specific or, that portion could be vetted in more detail. More specific doesn't mean more accurate, but it's an area that could be looked at with more scrutiny. Other revenue. So we get revenue from the state, we get revenue from excise taxes, we charge for services. I have that going up a little slower than our operating budget. It's 4.4%. And again, I use the historical average to get to that. All of these assumptions will probably be wrong. The hope is that in aggregate, you're going to hit it pretty close. And I think I've got a decent history of doing that. Tax shift benefit model doesn't use that very much. The only thing I contemplated for a tax shift benefit was the public safety debt service, because that's real. We are actually using TIF funds to pay for 50% of the debt service on the public safety building. There is an implicit benefit to doing that in the form of saving for the state funding formulas and county tax. I gave a credit for 50% of the public safety debt service, and 58% of that was kind of, when I say we can afford 13% of our budget to be for debt service, that's where that credit's applied.
Can I ask a question?
Yeah.
So since it seems like you were conservative in applying that, so down the road, if we actually did use TIF revenues to help offset the cost of the community center and maybe the school, is what I've heard, that, the numbers could actually be a little bit more favorable than what's currently in the spreadsheet.
That's correct.
Okay.
That's correct. I did not factor using TIF funds or any benefit for a school or community center.
That
just
was my
for the
question.
public safety building. Again, if you want to say 15% is what we can afford for debt service, you could change it here, and it'll flow through the rest of the model. I assume 13, which is right about what our historical average has been, and it's been pretty consistent as well. I'm assuming that outside of major projects, we're going to issue $6 million a year, and it's going to grow by 4% a year. And on those issuances, we're going to have a 4% interest rate and a term of 10 years. We played with a couple different options here, but it seemed like 10 years was the average for what we've typically done. This actually isn't used very much. So when I calculate what we can afford based on that 13%, so let's say we're only spending 12% of our budget on debt service, that leaves 1% left, right? Well, what can that 1% buy? Well, this assumes if it's for a major project, it's going to be spread over 30 years at 4%. Doesn't impact any of the results, but that's why it's there. Real growth due to new development. I have it pegged at 1.5%. Our 5-year average is closer to 2%. I don't think that's going to continue. Although we exceeded this year's growth was far in excess of, I think 2%. So there's some uncertainty there, and the model that's a pretty big impact. If this goes to 0 or 0.5%, that has a real impact on the tax bill for a $400,000 property. Interest rate for the library currently is, I'm assuming 4% over 10 years. For the community center, I'm assuming 4% over 30. And for the school, I'm deferring principal for 5 years and then amortizing at 4% over the next 25. My issuances are a little different than Joe's because of what Tom was saying. We don't issue ahead. So we typically will spend the money and then issue the bond the next year. So worst case that I have contemplated in the model is, fiscal year 23, we could issue $1 million for the library. These can be tweaked a little bit as well. I have 7 million the following year and 5 million after that. Community center, I'm assuming nothing next fiscal year. 24 could be 2 million, then 20, and then 18. And then for the school, this is actually offset 5 years. This is how I made my model cheat. So if you move these back 5 years, it's assuming 2 million and then 15, then 93, and then 27. That's the nuts and bolts of the model. Modeling isn't an absolute science. It's done to help you understand the impact of changing assumptions or changing or devising a different strategy, right? So, take it with a grain of salt, use it for what it is. But I think the big takeaway for me, and I guess I'll say this, is I'm not going to recommend that we do all these projects. I don't think we will. But if we did, there's some tools at our disposal that could help manage the impact where it's not going to, your taxes aren't going to go through the roof. That's. Yeah.
Thank you so much for doing this first, because it's just excellent work. So thank you so much for putting all the time and effort into it, because I don't think I could have done it. And so I really appreciate you taking the time and thinking so thoughtfully and partnering with Joe to get us to this point as quickly as you did, because this was kind of, I think, a last minute ask, and the fact that you were able to pull this together. Just one, thank you for doing it. I have a question about the library, because you mentioned it earlier, and I just looked at the bond language that we have tomorrow that we're going to be discussing. So in your model, you're assuming we do a 10-year bond, right? Because of the favorability of what we're seeing likely for that in the future. But in the bond, we're suggesting 30 in the referendum. So is that something that we may need to reconsider?
I was going to bring it up tomorrow.
Okay.
And so Joe actually has the actual amortization schedule for assuming 10 years. What you put in the bond language is usually worst case scenario, but there's language in there that gives you flexibility to change. But I think we want to be as transparent with the voters as possible. So I think it's worth talking about. I don't know if I'd suggest doing one or the other right now.
Okay. But to your point, like, I guess maybe that's more of a conversation for tomorrow. Because if I'm a voter and I'm reading this and I'm voting on a 30-year bond and we decide to do a 10, we have the authority to make that change.
Yes.
And
Yeah.
the bond language gives us that authority, even though it's not clear to me exactly like what.
Yes,
language-
the bond language is really this there for explanatory purposes. And you're right, the 30-year scenario at 4% could be considered worst case scenario because it's the highest interest expense. But it does not bind you as a practical matter. In this case, with all bond issues, we'll make those final decisions. You'll see them as part of the bond order that comes forward in terms of how long we're bonding the different projects.
And the language in the balance is not to exceed X amount of dollars, not to exceed X amount of years.
Right. It's not uncommon, particularly for the annual borrowing for all the smaller CIP items. You'll see a long list. There could be some as short as 3 years, frankly, and some as long as 30 years and everything in between. It really depends on what the item is, what its life expectancy, value, so on and so forth. So it doesn't bind you. I appreciate that it might be a bit confusing.
Yeah, I guess my inclination would be to leave it, but it's worth, and Tom actually did reference it in the cover sheet.
Yeah, I think conversely, had I 10 years is very aggressive. I think it was a bit of a late revelation, frankly, in this exercise. And it really is born out of the fact that we've got some near-term capacity to take on more debt. And So that's why that kind of more aggressive principal payment makes some sense. I think had I suggested that, I think there might have been some concern that we're understating what it might be otherwise. So at 30 years at 4% is really kind of worst case scenario in terms of informing the voters what it could be.
Well, this is the benefit of the modeling you did, John, is that, I mean, as late as Friday, we were talking 30 years to the library. And only Monday morning did we change it to 10. But that's because the model showed us that we could absorb that. And my God, it opens your eyes a little bit as to what you can do.
Again, the model being based on the premise of managing to that 13%, you get that capacity in the near term, you fill that capacity or you use up to the 13% to pay down principal upfront, if you will.
And if you borrow 10 years, but I didn't change my assumption interest rate, you're talking 3%, not 4%.
Maybe just
That's good to know.
another question for you, which might be an unfair question, but I'm gonna ask. Is, you know, in your modeling with your escalator for operating budget, do you think that's gonna like safely cover what we would anticipate to be the added operating expenses for these projects as well? Because I know especially for a community center, right? Like a pool is pretty expensive to operate, maybe not in the grand scheme of the budget, but do you think your escalator is considering that in a way that those would be covered in there, or is
So-
that maybe more conservative?
It would, you'd have to manage to that. So you're essentially, when we get, when a budget's brought forward, that's one thing that we would be looking at is, are you staying relatively close to that 4.5%? There might be some bumps
Mhm.
and a little better in some years. You know, if you want to look at the history here, well, this is 2023, we're 6.2. Okay, but in 2022, we're 5.3. Well, we went, it was only 2.7 in 2021. That's the budget we put together in 2020. And it bounced around a little outside of that. I do think it's a reasonable assumption to assume that we could average that. I think you would get some efficiencies from some of these things. And the other thing that I don't think is represented is you'd have some new revenue streams from the community center that's not contemplated here.
Yeah.
That could offset any increase in expense there as well.
I mean, keep in mind, I believe each of these projects needs to stand on its own merits. And I think that question of operating costs had been raised directly to the library, because that's the one that's kind of further along and closest to getting to the voters. I would fully expect those same questions being asked of the other projects as they develop and come to fruition. We've not had the time and put the effort into modeling that additional operating expense at this point.
Okay, but it would, I mean, I guess maybe it's not, it wouldn't be significant increase to this, is I guess my question.
Well, that's within our discretion,
Mhm.
right? We set the budget. So sometimes you have to make decisions. If you don't want to impact the mill rate, this is assuming 4.5%.
Mhm.
There might be reasons to do more than that or less, you know, in any given year.
Mhm.
I think it's a fair point, additional revenue streams, and I think there are very likely efficiencies. So I think that was a point raised in the library discussion. I expect a brand new school replacing, 3 old schools. Yes, it's larger and all, but we might be surprised that the operating expenses are not significantly different.
This just speaks to the challenge of modeling
Mhm.
too. I mean, it's one thing to model the bond payments, and we have a amortization schedule, and we have a valuation that we can measure those two against and come up with a payment that we think is going to impact the taxpayers, and we can calculate that. But then to say, how are we going to absorb potentially, 396,000 is the potential operating cost of the library? And does the 4% increase reasonably absorb that number, or are we talking about being in excess of that number?
Yeah.
Right?
So just one other question, because again, I think this is the question we keep getting asked, and I want to make sure hopefully we can have a real answer going forward. So for the library next year, because I think this is the question a lot of people want to know, like for a $400,000 home, according to the data you shared, is it safe to say that would be $78 added to your
Yeah.
tax bill for
In 2024 and then $94 in 2029.
But that's only if we're doing the 10-year, and if we did a
So-
30-year, it would be maybe $41 looking at.
Let's see, I can do that. So if we change it to 30 years, now you're looking at $37 in 2024 and $44 in 2029.
I think that's important information that we have to figure out how to communicate. I know we've been asked by the library a few times how to do that, and I don't know if we've ever given a number, so I don't know.
Well, this is what we manage a portfolio of
Mhm.
debt. So it's hard when you try to pick out an individual project. But well, what are the assumptions? You can show an impact. There is a real impact, but there are offsetting impacts from other decisions that you're making that aren't shown in that number.
Mhm.
Um,
I do think it's important if we, as a committee, are, going to discuss this, especially tomorrow night. We know this is going to be part of the library discussion tomorrow night, that we have a clear graphic. And I know, because Cape Elizabeth just did this, that is what the residents of Scarborough are going to expect, is this is your impact to your tax bill for the library project as a standalone project. And with some level of confidence, we should be able to say, on a $400,000 home, this is going, the first payment is going to be in 2024. This is going to be the impact to your tax bill.
With asterisks and estimation.
Yeah.
That's the thing. And so I guess, so let's just say it if it needs to be said, that some of the graphics that are circulating around for Cape Elizabeth are based on a lot of assumptions, and that is an oversimplified
Mhm.
graphic.
It's pretty,
Maybe.
it's an inaccurate graphic.
Okay.
No.
We know the danger of narratives that are inaccurate.
I mean, assuming that your valuation is never gonna grow, but taking a level principal and interest payment. So it ignores the time value of money, is what it does. And that's the whole point of debt service management, is understanding that time matters. So I mean, if you had to say, if you want to be consistent with the ballot language, it's
Yeah.
gonna range from $20 to $44 on a $400,000 home over the next 30 years.
That's like a fair
So do I.
statement. Best estimate, it's $20 to $40 or whatever. I think that's.
If we accelerate it, it's gonna be more shorter term, but that's because we can afford it.
Mhm.
Other questions
had a
for
question.
John, and then I can go to Dawn.
I might have more.
All right,
But-
Dawn, why don't we go to you, and then I have, I think, a couple left too. And then I'll take.
The model's been very helpful, John, so thanks for that. And I know there are a lot of assumptions built into it, and it was helpful to see how, that holds together. I am perhaps more concerned with some of the things that aren't on the model, and we touched on them very briefly. Those include operating expenses, we touched on that. And I know that's not really Joe's domain, but I hope that that's something we'll have a robust discussion about, tomorrow and in the next couple of weeks. My understanding is the library, for example, is going to be doubling the size of their staff, with this proposal. So, we would want to have a good handle on that. The other thing that troubles me, and this is something that's down the road and we tend not to worry about it, but you showed the 25%, increase in assessments in 5 years that's likely to hit. So, I hope that in the course of these discussions, we will be focusing also on operating aspects of that and what capability we may have to try to break that down. It's going to be a shocker that people don't care about until 5 years when they're writing checks. So, and I know that's a different matter. The final question I had is going back again to Joe and the beginning, and we're going through all of these numbers and Moody's and Standards and Poor's and all that sort of thing. Is it, and my understanding of this is, is a little sketchy, but is it safe to say that, those ratings are sort of the municipal equivalent of our own consumer FICO scores?
Absolutely.
So that basically says we're great credit risks.
Yeah.
You know, we can carry a heavy debt load and we can be expected to pay it back. So the question is, well, it raises the age-old question for me, just because we can do something, does it mean we should do it? So, and, our history, in terms of managing, our debt load, I think it's been positive in some ways, but we're assuming we haven't really talked about broader issues. What happens if we roll back the clock and we end up looking at what happened in the 80s when there were very high interest rates and there's a lot of action in the municipal sphere, a lot of defaults and pension fund defaults and that sort of thing. So what happens, in the case of those scenarios? I know these models don't capture that, but could you give us a couple of minutes on that?
Well, the project can also be deferred. It could be financed. It's dangerous to face interest rates. But I did a situation for SED 51 where we had a $10 million financing. And the day of the sale, Lehman Brothers and Bear Stearns both died. We pulled the sale, we did a 1-year ban, and instead of getting a ridiculous 6% bid, we sold the bonds at 4% a year later. So the cost of the ban allowed us to have a more stable market. The other aspect is we have part of my future responsibility is to choose a market timing that makes sense for the town. But and it relates to the FICO. The max FICO score is 820. TransUnion is Moody's, and the other one is S&P. And so you're 790 with Moody's, and you're an 810 with S&P.
Okay,
In your FICO.
that's the equivalent.
Yeah.
Great, thank you. That's helpful. I mean, it's good to know that there are strategies for us to mitigate in the event, of things that could happen that are beyond our control, but
And what you might do also, if the rates are usurious, then you postpone the financing. But if rates seem to be at that level, finance what you need over a period of 12 months. And then subsequent to that, things get perhaps a little bit more bullish, finance the balance. But it's a matter of paying attention to the market.
thank you.
Thanks.
I'm gonna go ahead and recognize Counselor Katerina is online. I got the little pop-up that she had her hand up. Maureen,
Hello, can you hear me?
we can hear you.
Oh, cool. I'm glad you can't see me. That being said, thank you. This has been very interesting. I've been following along from home while I've been working on a couple of other things. John, thank you so much for the modeling. That was interesting. One question I have, and I don't want to be the skunk at the party, so to speak, but it is a reality that I don't know how long it's going to last, is have we looked at the effect of the senior tax freeze in any of the modeling? And some, some folks who are concerned about, oh, you're going to add $30 to my tax bill. Well, if you're over the age of 65 and you've frozen your taxes, you're not going to see it if you, apply for this program. So anyway, I just wanted to, muddy the waters a little bit more.
Thanks, Jean Marie.
Tom might correct it. My understanding of that program is that the impact on your local taxes is going to be the same. The state is going to cover that subsidy.
That's exactly right. We still have lots
What
of
happens if
questions.
it's not funded? I don't know.
Whether they'll.
Right.
That is the plan, that the state will fill that gap for us. So we should be made whole.
And constitutionally, the state of Maine's constitution is you have to have taxes fair and equal to everyone. Doesn't mean you can't give back, which is the whole basis of TIF.
Right. So I just wanted that pointed out to people who may be on this call or on the Zoom call, that, and yeah, hopefully, I pray it'd be awesome if the state continues to fund that, but we all know how politics works. But I did at least want to throw that out there, and that's it. That was my only question. Thanks.
Thanks, Jean Marie. Counselor McGee.
Can I ask a quick question while he comes up to the podium? So, John, thank you so much again for doing this, and I think most of your assumptions are very, very reasonable. Which of these are the most sensitive that if we were to change them, have the biggest impact to the model? Or is there a couple that, as you were doing this, you just recognize that some things are very sensitive?
I didn't do a sensitivity analysis. I played with growth numbers. That's why I tempered it down.
Mhm.
But it doesn't necessarily have a huge role in the impact analysis of these projects, but on what the actual mill rate is in 10, 20 years, it does have a pretty big impact.
Okay.
Um,
So you
so-
can play with that yourself. at
Yes,
home if you
yes,
wanna.
and enlighten us.
Yeah, okay, good.
Go ahead, Nick.
Yeah, hi. Thank you. First, thank you, both Joe, right, and April for holding this, and John, all that work. Wonderful. I like the idea of having this model. That is following up with John's thought here. I think as a council, what would be probably a good exercise is one, figuring out, can we do them all? Right? I mean, I think that's step one, right? All of those projects that are lined up, can you actually do them all? If the answer is yes, in theory, that you can do them all, should they be ranked in some sort of priority? And if you do start to rank them, how do the projects fall in the bond, and where do they fall year to year? And if the answer is no, and you can't afford to do them all, what's getting cut? And I think that's where playing with this model can kind of come into play as well. So, and then of course, if the order changes as to which projects go first on that, how does that impact where your tax rates end up at the end of the day too? So it's nice that we have an interactive model, but I think from a bigger picture viewpoint, I think we should probably be answering the question for the public as to whether or not we actually even believe we could do them all. And I'm not sure there's a clear message from this council saying that there's the appetite or the ability to do that. I think that's probably something we should try to circle the wagons on. Just a thought.
So we are going to have a workshop before our meeting tomorrow, and the school departments graciously agreed to join us and help us understand the project a little bit better. But we have not, as a council, other than funding some studies, tried to sequence or prioritize one over the other for these projects.
And to that same point, the community center committee wrapped up their work, but they did not present final findings before the council. Is that correct? And if they did, it was before my time.
They did, we just
and
put
so
them
it
on a
would be
shelf.
good to, yeah,
Them-
so that's been on a shelf.
Yeah, I would
That's
say community center, though, it's been long talked about, if it moves forward in the near term, it will really be out of opportunity that kind of presents itself to us. In my mind, there needs to be some kind of motivator to vault that into the front. But a lot of great, very good work that we can dust off and pick right up with has been done. So it's not far from the finish line, frankly, and we do have money in the budget to start to refine those designs and cost estimates further.
That's right. So at this point, I'm going to go ahead and turn it over to public comment. And we can kind of, I'll try and be as generous as I can with time. So that everybody who would like to make public comment can make a public comment. And if anybody would like to respond or is able to respond, we'll do that accordingly also.
I'm Sue Hamill. I just have a question, if you could clarify for me. So when you're doing the impact on the $400,000 house, 5 years from now, that will be a $500,000 house. So the mill rate, I mean, so that's confusing. And I would like to take that one house, that's very same house, if the same person owned it for the next 30 years, what is the impact on that house? Assume it continues to inflate in value. The mill rate will come down, but it just is kind of muddled when you're trying to understand, so when you're talking the impact on a $400,000 house now, and then a $400,000 house in 5 years, it's two different houses, because, that was the 300 and something $1,000 house. Yeah. And
I agree with you, Sue, and I completely understand what you're saying, and that speaks to the reval question too. These numbers are what is the impact on a $400,000 house is in a fixed period of time. But then, of course, we have to alter our assumptions to assume that a $400,000 house in 2024 is no longer going to be valued at that same valuation 5, 10, 15 years from now. And so the impact to that household will also increase as a result of the increase in their valuation.
I also think, you know, kind of what Joe shared earlier, like some of the impact is going to be different. Because if you think about it, the person who lives there today is going to be spending that money and enjoying that benefit.
Yeah.
And they may not live there, and then somebody else is going to move in, enjoy that benefit, and be paying towards it. So to know, I guess the assumption that I'm hearing Sue is like, assuming you are going to live in your home for 30 years, which I'm sure many people will, what is your total contribution over that 30-year period? I just don't know how likely that is for a lot of people, but it's worth kind of understanding the total 30-year cost.
What's also built is if you have a $400,000 house this year and 5 years now, it's a $500,000 house. The additional increase in other tax base should mitigate that so that your tax bill stays at $6,000, even though, because your mill rate has come down. So in a perfect world, it balances, much the same as we talked about your 2.09% equalized assessed with extra this should be offset by that. And it's not a perfect world, certainly, but I think that's half the answer to the question.
Yeah, I mean, so the fact is every house is gonna have a different life cycle, right? If you don't take care of it, you will stay at 400,000, but if you're on the water and you've made upgrades, then you're probably gonna go up. I think what you're really talking about is the mill rate and with the reval, I mean, the way the model's kind of showing is it's gonna go up 3% a year, your mill rate, and then every 5 years it's gonna come back down and reset. That's not going to be reality for everybody, though.
Right. Go ahead.
Good afternoon, everybody. Peter Hayes, 5 Indian Hill Lane. Just a couple observations and a couple comments. One, I think this really has, and this, I'm going to sound like a broken record, but this financial modeling is just really important. So John, thank you for doing that. You put a lot of effort into it. But this really should be a tool that we have available to do all of our strategic planning instead of doing it sort of at the nth hour Monday morning. It'd be really great to be able to have this as part of your weapon and portfolios to do that strategic planning. So I've made a case for that for a long time. I think that's really important. Two, and Tom referenced the physical policies, the policies we have. And actually, I spent some time working on those as well. But I think there's a process by there's supposed to be an annual report out. And if there is, I think to Joe's comments, it'd be really important, I think this year, as we head into these bonds, that we make sure we dot that I and cross the T. So we can say we've done due diligence and done that. And then the third thing, kind of the talk, but we've had a lot of conversation around the mill rate and the mill rate staying even. And Joe, I think you said people only care about the short term, not the long term. I guess I'm not the normal person because I care about the mill rate my whole life expectancy here in Scarborough. So, but I will say when we talk about a reval, and we're to be clear to people, for on average, if the mill rate stays the same, that's going to be a 25% tax increase in 2025 as you've modeled it. So it is a tax increase. All things being equal, the mill rate stays the same, which is what you've modeled. No? Well, okay, but that's. And then the other thing I'd say, as you know, we're assuming, and what I've heard a lot of conversation about is what can we afford for debt? But there's an opportunity cost to debt. The other side of that equation is if we didn't have that debt, what would happen to the mill rate? That's the real issue for the taxpayers is if we didn't invest these dollars, the mill rate would come down. And so I think it gets to some of the other questions. What is the community's priorities? What do we all as a consensus of what do we want to pay for? I think that would be important. And then the third thing would be, we didn't talk at all about the downside risk. If our bond ratings change or other things in the marketplace change, that could have a significant impact on the debt service going forward too. And I just think that should be, there should be sort of two scenarios, maybe an upside and a downside. I just think we should look at that. And then I think, as we think about, and I think this is what they did in Cape Elizabeth, which I think is a great model, we're talking about how do we flatten the mill rate? But I think at the same time, we should try to figure out what is the lowest net cost for us to put these projects in place. If we extend out the payments or do some other mechanisms to flatten the mill rate, but it ends up costing us more. Let's focus on what's the lowest net cost and how do we get there? And I think the issue when you said about make it clear for the ballot for the library, this isn't a conversation just about the library, because we're talking about three major projects. It'd be really nice to see for the taxpayers to see the total impact is going to be X. Is that acceptable? And if that X isn't acceptable, what do we want to do first?
Thank you, Peter. Go ahead.
As it relates to the rating, once the bonds are issued, the rating can go up or down, but that doesn't change the rate. They are written in stone, they're fixed income. And the expectation is the worst case scenarios, we maintain a AA3, AA+. What we'd like to do is get us to a AA2, AA+. But I don't see the downside, but of course.
It could be.
It could be.
Before the bond is issued. Absolutely. And right now in the marketplace, if anybody's got a crystal ball, I'd like to know.
Absolutely.
My portfolio is actually higher. So
That's right. Rates gonna go up and they're gonna go down, I just can't tell you when.
there you go.
I'd just like to say, I remember vividly, Peter, you advocating for both the policy and the model and you fought for it for a long time. So, kudos.
Thank you for doing this.
Marvin Gates, 423 Black Point Road. Those are very tough acts to follow. I have one observation, and that is, I don't know you well enough to call you John, but I'm going to anyway. Everyone has a comment about your analysis and your spreadsheet. And and obviously everybody's been very thankful, and to the degree that I understand it, I'm thankful too. What I don't understand is why the town hasn't employed an independent person. I know you said you don't have a way, one way or the other, as far as advocating one way or another. I'd like to very much see an independent person, and I can't call you Joe, but I will. I mean, you do have some dog in the fight. I understand you have your own responsibility. I think that covers it, if that makes sense. It does seem a little bit observationally, as though it's sort of done quickly. I think that's a word you used. And that makes me very nervous. Thank you very much.
I think those are fair comments. It was done quickly. We don't have a school in our capital plan right now. So this work is in response to some, I think, public feedback and outreach to try to understand a what if situation that is extremely unlikely to happen, and nor would I support happening, but I don't mind helping us understand what that might be.
Yeah. Can I just add to that, why I agree too, but I guess one of my concerns is, having town staff, because I think they should be our resource to create this type of modeling. And I know we're in process of looking for a new finance director. I feel like this is the type of stuff we should also be able to lean on town staff to help us better understand. I appreciate your skills and I know you have the background, but to me, town staff should be our objective neutral party because they should be looking at it. And I don't know if we need an independent person, but we do need the team here who can help us do this analysis.
Yeah, and so to be fair to the current state of things, we're to that point asking John, and I'm in my capacity as finance chair, trying to respond to constituent needs, trying to respond to council needs. And this was kind of the path we had available to us right now, which is, why I asked John to do this modeling in preparation and then, again, this gets into the weeds a little more than we need to, but Colette and Tom were at conferences last week and Joe was out one day, and so a little bit of the hecticness of the packet and the reason the packet changed multiple times was because we were trying to pull something together and have it posted when we normally have the finance packet posted, which is Thursday. And then I had made some changes to John. So I take responsibility for
the ever-changing agenda on this one as well. That being said, we have had a really productive meeting for the last 2 hours tonight. The model is now available to the public. It can be, to your credit, it can be manipulated and tweaked, however people would like. I anticipate a robust discussion tomorrow night regarding the library, which is only first reading. And then we have another 2 weeks' time before second reading on the library to field questions. I am happy to entertain the idea that perhaps we would have another finance committee meeting in between if that feels warranted by the rest of the council. And so we still have some time and some steps that we can take to make sure that the public feels informed and that count and as open, these meetings are open, and as much as I love the public participation, my primary focus is to make sure that the council has the information and the understanding that they are seeking. So if I get feedback from other counselors that they would like for the finance committee to meet again, then I'm happy to oblige that request.
Thank you. Richard Hayes, Martin Avenue. I'm a real simple guy, and there's been a ton of numbers thrown out tonight. A lot of which I don't understand, and I would venture to guess that a good number of people don't. What I understand as a homeowner is my tax bill. And I think I've heard tonight that spending $180 to $200 million isn't going to affect my tax bill. I'm sorry, I don't believe that, because I'm in my 49th year in Scarborough, and my tax bill has increased, I believe, every year. So whether you spend 15 million or 150 million, that is going to have a direct effect on people's tax bill. And I think that's the important information, that not just what a $15 million bond or a $13 million bond is going to have an effect today. I think what I am asking for is that all of these projects that are planned in the next year or two, that the effect of the 200 million, 180 million, whatever the number is, that information gets relayed to the taxpayers, and not on a piecemeal basis. I personally believe that this, and tonight may not be the time to say it, but I believe that the library has been positioned to do it now before we have to talk about the bigger amounts of money. And that's just wrong, in my opinion. So, thank you.
Thank you, Mr. Hayes. John.
So that just gave me a thought that I'm going to say out loud, and maybe it'll catch, but on our tax bill, we include, I think, some detail about how much funding is coming from the state. It may be something that we consider in the future, how much of your tax bill is going towards capital projects or debt service, something along those lines to make it. Don't know if it's a good idea or not, but thank you.
Go ahead, Mr. Nagrin.
Owen Agron, 16 Phillip Street. Unfortunately, you have remembered who I am. Can the dollar impact on a median home be included on the ballot, but only if it gets the votes? Because that seems to provide some pretty good clarity, right? People want to know the dollar amount, but if you just say 14 mil, well, they don't really, they're just basically going to rubber stamp that. But if you tell them, hey, you, the voter, are accountable for $40 a year, whatever it may be, that's good information to know. So could that be included?
I'll have to check.
Thank you.
Quite likely, it would be in the explanation section, not unlike the draft ballot that the council has in front of it for consideration. Could be additional information.
Okay, but I think, yeah, I would certainly at least request that, only if it gets the votes, of course. at 14 mil, could this library expansion impact our bond rating? I guess I'm asking chair, or
I don't see that.
you don't see that?
I don't see any impact whatsoever.
Okay, so is that like pretty much guaranteed?
I can only guarantee life and taxes or death taxes.
Okay, I heard also that population growth could support the bond, yeah, I guess the bond rating. But that's definitely the number one issue in town, I would say right now. I've gotten on the council a variety of times, and I'd say that if we're inflating the population as a financial strategy, I can't support that. I think that actually we're heading towards our second GMO revision now to basically get it under control. So does that potentially impact your answer?
I didn't really include, I assumed an increase in population because the trend has happened, but I didn't include it in terms of any of my numbers, like for example, the $4,200 in debt per capita. I didn't, forecast it because you're gonna have 5,000 more people. I left it the way it was, assumed it's static. If it happens, it happens. But it's not something I advocate or quantify.
And this is just a general question because I don't know. When municipal bonds mature, what happens?
The paying agent puts void on them, sends it back to the town. The investor's paid off and you go on with your life and you have no more debt. Very similar to a house mortgage. If you had a 10-year mortgage in your home and after the 10th year you pay for it, they send you paid, you get the house back with no debt and you have your name on the lien.
Okay, so that wouldn't impact potentially this project because they wouldn't mature before we've paid for the library.
They would mature each year on like an installment basis.
Okay.
So as you have a 20-year bond, in the 10th year, about half of it's been paid for. You still owe the principal on the other part.
And then you have to roll that?
Sorry?
Do you have to, but you still owe that debt, right?
Yes, but it's just like a car loan or a home mortgage, yes.
Okay.
And I did it 4 years, I own my car. Then 10 years, I own my house.
So what if bond yields go up in the future?
The whole idea, there are three parts of a bond: the interest rate, the amount, and the maturity.
Mhm.
Once the bond has sold, those do not change. So if you had a 2% bond and rates go to 6%, then the investor has a 2% bond. And however, if we have a 5% bond and rates go down, as we've done a bunch of times in Scarborough, we finance it at 3%, you have a 3% bond instead of a 5% bond. Personally, I mean, I refinanced my 4% mortgage at 2 7/8 last August, and I look like a hero.
Right, but then you can't go the other way though. That's what
I'm sorry.
but you can't go the other way. You wouldn't,
I wouldn't refund it for more money,
right?
but I'm not obligated to make the investor whole should rates change, which is why it's called fixed income.
Okay, so
fixed rate.
that's really not a concern for this project then.
Any project.
Okay,
Wouldn't be
Yeah,
concerned,
for any
no.
project.
Once it's there, it's there, written in stone.
all right, thank you.
Anyone else wishing to make public comment? Anyone online? Seeing none, I will go ahead and close public comment. Any other final council comments? Go for it.
I just want to thank you again for putting this together as quickly as you did and working hard. And John as well for Cole and Joe for putting this together. I think this was really impressive, the work that you guys did as quickly as you did. So just thank you very much for coming today.
With that, I will ask for a motion to adjourn.
So moved. Second.
All those in favor? Thanks, guys.